Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his good friend, Mr. Jonathan Twomley. How you doing, sir?
I'm doing very well, Michael. How are you?
I'm doing well. Thank you very much for being a part of the channel. You've brought so much value, history, and experience, and really cover an area that I have zero experience in. So thank you for being a part of it.
Thanks so much. I love it. It's one of the highlights of my week every week.
Awesome, awesome. Well, one of the things I want to talk about is this notion of fear and greed. I will obviously talk about it from a kind of residential aspect, but I'm curious if it plays in the big stuff. I'm not sure. So if you don't know what we're referring to here, is a lot of kind of investing is psychology based. And certainly my experience, it's what pivots, what breaks. And when it breaks, it doesn't flip-flop, right? It breaks for a while, right? I think we saw the last 2 years where greed was winning. Greed leads to stupid decisions, lack of homework, beliefs in frauds, lots of those things. And then at some point it breaks. And then fear takes over for a while. And, fear leads to being retrenchment, probably staying in cash, and, all of those things. Warren Buffett says, when the tide goes out, you see you swimming naked. I experienced, my best buying in 2010, 11. Nobody was around. So I want to talk about fear and greed, investor psychology, and how it may or may not play in large multifamily investing. What do you got?
Well, yeah, I mean, just like any other investment class, it's absolutely a factor. And it is, I think sometimes people make the mistake of thinking that institutional investors are somehow, can put all the emotion aside. And
it's just the numbers, Jonathan.
It's just the numbers, and they're really good at sorting the noise from the from the signal, sorting the signal from the noise, right? But the fact of the matter is that they're just as susceptible to the greed as anyone else, and to the fear as anybody else, and that's actually demonstrated pretty conclusively in the book of Rational Exuberance. Which, if you are an investor, you should absolutely read this book. It doesn't really matter what you invest in. It's all about market psychology. And one of the things that was, first, I can't believe I'm blanking on the author's name because he's so famous. He's a Nobel Prize winning economist.
I'll look it up.
But one of the things that he talks about the fact that the institutional investors were no better at resisting the hype in the great financial crisis than anybody else. And you've definitely seen it. I mean, I've seen
Robert Shiller, by the way.
Robert Shiller, yes. I don't know how I could have forgotten that. Robert Shiller, the great housing economist, right? So what I have seen over the last 5 years is everybody's standards have changed, right? Everybody who is a conservative investor has made their underwriting much more aggressive. Even me, because you've had to, right? You just couldn't buy deals without becoming more aggressive,
right? Or
changing, more aggressive. Let's face it. Like the margin of safety that you were able to build in to a deal when I started in 2014, 2015 is impossible to build in. Well, that may change now because of what's going on, but what you saw was people coming up with more and more generous rationalizations for why they should be paying what just a couple of years ago was way overpaying for everything. And definitely you hear the same kinds of it can't fail. It's always going to go down, go up. It's, I'm sorry, my texts are going nuts. The very same kinds of psychological factors are at play for the large investors as they are for the small investors. So they may be dealing with a little bit more information, but I think they ignore more information than the little guys do. They're still making the same kind of psychological choices or lack of choices as everyone else.
Yeah, when I look at the multifamily area, and I knew we were going to talk about this one today, I think there's several layers to this, or at least, again, this is my opinion. I'm asking you to kind of correct it. The first one is what you just talked about, right? It's deal analysis, I'll call it, right? 5 years ago, you had all these, buffers. I'm not sure what else to call it, or margin of safety, I think you said.
Yeah.
And obviously that got whittled away as more and more people came in. And when I say more and more people came in, it's what I saw in 2019 and 20. Everybody was a syndicator. It was the hot thing to do.
Yeah.
And more competition, more energy, less due diligence, less homework, right? There's the deal analysis that fell away. But the second layer, and I actually think will cause probably the most acute pain, is at the LP level, right? LPs, right? These limited partners would come in and do less and less due diligence on the operator, less and less due diligence on the deal, less and less due diligence on the market, right? They felt like, again, the money was sitting in the bank earning zero, so they felt like they had to deploy it. And the level of due diligence I saw by LPs went down and down and down. And do you think that's true or no?
I mean, it's hard for me to say what kind of due diligence LPs were doing, but I think that in terms of the kinds of conversations that I was having with people, people seemed a lot more, let's say, forgiving than they had been before. Like, they sort of put me through the ringer a lot less, asking me about me and my background and my, the deals itself. Oftentimes the questions I started to get, in the last couple of years were like, do you think it's a good deal? Right?
Yeah, exactly. And it's like, that's exactly right. Yes.
Yeah. And it's like, well, I mean, if I didn't think it was a good deal, I wouldn't be doing the deal. So of course I think it's a good, I always tell people, like, I can't advise you, right? I'm not a financial advisor. I can get in a lot of trouble if I give you advice about investing. So I can't.
Right.
All I can tell you is I wouldn't be doing the deal if I didn't think it was a good deal. But you have to go figure this out for yourself. If you think it's a good deal, take it to your lawyer, take it to your accountant, right? But people wanted to they were like all ready to go. And
that's exactly what I saw.
Say, like, oh yeah, no, it's a good deal. Go do it. And like, okay, that's sort of what they wanted to hear.
Yeah.
And
I'm sorry, Jonathan. I saw people write 6-figure checks to somebody that did a 15-minute pitch that they never met before in a market they've never been to. I cannot believe people did that.
Yeah. I mean, listen, I had on every deal I've done over the last year or so, I've had people invest with me who I'd never met before, right? They were on, and now maybe, maybe they've been on my list and they've been following me for a long time. Maybe watching the channel, so they feel like they trust me. But I have no way of knowing that because I never spoke with them. But I would put out they were on my list. I put out a blast. One other thing that sort of happened which is interesting. I always used to require that investors get on the phone with me before I put them on my list. Right?
Oh, okay. Yeah.
But I started finding that to be like pulling teeth. Like, nobody wanted to get on the phone. They just wanted to be on the list. And
they wanted to look at the deal, look at the deal, look at the deal.
Yeah. So legally speaking, because of the change in the law, depending on what rule you were using, you didn't need to have a relationship with anybody beforehand, where you used to have to, right? So since everybody started doing what are called 506C deals anyway, these are deals where you don't need a pre-existing relationship, but the investors have to prove that they're accredited.
Correct.
Right? I think a lot of people just were like, I don't really want to take a half an hour to get on the phone with this guy. I just want to see the deal. And then they just made a decision on the deal. And of course, deals, look, I mean, it's marketing, right? I mean, truth be told, it's not, I think like the deals I'm involved with and the deals I sponsor, try to really vet them. Yeah. I mean, like, I do my due diligence, but the marketing package that you see obviously is like putting it in the best light because you're trying to attract people, right? You still want to,
and again
about it, but it's like, it's still advertising. But people are just looking at that and like, oh, okay, they're promising me, not promising, but they're projecting this kind of return. Good.
Yeah.
Here's my check.
Yeah. In the greed cycle, and we'll switch to the fear cycle, because I think that's where we are at, or at least going to very shortly. In the greed cycle, as it gets to the peak, which I think we've hit, that's where fraud, shysters, criminals come into play. It's where a lot of LPs have already lost money and don't know it. That's how cycles blow up.
Yeah.
So now let's talk about leaving greed, because I think it's pretty clear we're leaving greed in the rear view. It's now going to fear. And fear is going to manifest in lots of different ways, my opinion. I think it'll be harder to raise money in
Absolutely.
6 to 12 months than it is today. Yeah. And that's going to be a lot of that actually is going to be horrible timing, because at least in my opinion, because you have deals in flight with bridge debt and variable rates that, there are resets coming to. Rates are going to be higher than their operator expected, which means capital calls are probably not far off. And if you have to issue a capital call into a market that switched from greed to fear, you're going to get a lot of no answers.
Yeah.
And there may be some pain there. So not only is it going to be new deals harder, I think it might be harder to keep existing deals kind of past the refi or reset or whatever it's called.
Yeah, I mean, if they weren't really solid deals, right? So
exactly, yeah.
And listen, I mean, I want everybody who's listening to the channel right now to hear this, and that is, great opportunity is coming. You have to be able to put aside all the noise of like the stock market falling and crypto falling and deals going sideways to understand that this is when the best opportunity is, right? And I always try to educate my investors to understand that when they're, Warren Buffett's, aphorism, or, is absolutely true. Like, be greedy when others are fearful, right? And be fearful when others are greedy. A great opportunity is coming because of this. The first real opportunity we've had in a long time. And, me and some of my more sophisticated syndicator friends are starting to do things like, search CoStar for deals based on when their debt is maturing, right?
There you go. Exactly.
Especially if they've got bridge debt, right?
Yeah,
and
you should.
In the next year or two, right? Some of those people are going to be in a fire sale situation. And for us, that's great. But of course, I do run into the problem of, the normal investor is going to be frightened because their stock portfolio has taken a hit, right? Maybe some other deals that they're in have gone bad that they bought at the top, and they're going to be like, oh, I'm worried about this now. That's really the wrong thing. That's the time when you should be rushing in and grabbing every spare dollar you've got and putting it into real estate. Not at the top when everybody else around you was doing the same thing, but human beings are what they are. This happens every cycle. I used to spend a lot of time trying to educate people about this around 2018, 2019.
I was just thinking that. I sold an apartment in 19 because I thought this was coming, and then the pandemic screwed me up, and I had a 2-year lag on my apartments. I lost money. I sold too early.
Yeah, no, I mean, me too. But who could have forecast?
Yeah, who guessed it,
right? But I used to spend a lot of time, and produce a lot of content, which I'll have to go dig up now and then share with our audience. But
yeah,
about sort of market cycles and investor psychology and how these things work. Because what I was thinking in 2019 was, hey, look, the opportunity is coming, and I want my investors to not be scared off when it's there, because I want to do deals when the deals are easy to do, right?
Exactly.
And when there's a lot of fat on those, on those deals. So I was trying to get people educated and thinking ahead of time. Now, of course, like what's happened over the last 3 years since then sort of blew all that out of the water.
Agreed. Yeah.
And it almost seemed like the market cycle went away. But now, things have eventually, inflation caught up with us, and here we are, and the Fed is raising rates, and, a new cycle is starting. So, like I said, don't be scared. Be thoughtful about what's going on.
What I would tell someone today, again, really playing in your world, and I'm really thinking about the LPs here, because I think a lot of the fake syndicators are going to just wash out, and they'll never be able to raise money again. So they're going to go away. The good operators like yourself who have been conservative and frankly done less deals because you're a conservative will be just fine. What I would tell LPs to do, and I always tell them this, a lot of LPs come at the situation the wrong direction. They start at the deal, then the market, then the operator. That, in my opinion, is the ass backwards. For me, it is all about the operator. Then it is about the market. Then it is about the deal. And now I realize that is a slow way to the deal, but it is also a safe way to the deal. I think too many people get into the deal and they don't have no idea about the market. And then there's too many people that get into the deal, don't know the market. And then they go to the operators like, oh, I don't know who this guy is. Please. And this is how you build confidence. This is how you pull the trigger when you're afraid. You know the operator, rock solid, backward and forth. You understand his history. Then you know the market. You want to be there for a decade. It's not some podunk town you never been to, never will visit. And then it's the deal. So that's what I keep telling them.
Yeah, I mean, I think that makes sense. It's why I always wanted people to talk to me first, right? Because I wanted them to get to know me, because at the
I
end
think
of the
that's
day,
going to work in your favor in the next 12 to 18 months.
So, hopefully. I'm excited about
Me
about
too.
the possibilities to come. But that's, there's going to be some
Lots of pain.
Yeah,
Lots of pain.
There are going to be people who are going to, unfortunately, who are going to not, you're going to lose some money. And let's be frank.
Lots of money. Let's be clear.
I think, I'll be honest with you too. I think that there are going to be people who are going to lose money even with good operators, right? Because they're just going to be.
They started making, like you said right in the beginning, the deal analysis. In order to get a deal done, they had to cut out the fat. And let's be very, very clear. What's going to get some of these good operators is they've created organizations that they have to feed. I think that is going to be their downfall. I love operators that are skinny, that could, do a deal or two and survive. If you have a team that's like got to scour the plant, you've got to do 20 deals, and you're starting to put your name on garbage just because you got to make payroll. Ugh, that's going to hurt.
Yeah. I mean, I think we're going to see a lot of for some of the big syndication operations, we're going to see the marketing department get canned, right? And stuff like that, because they can't feed those people, right? If they can't keep on having deal fees, and especially because a lot of pretty much every syndicator, let's be honest, pretty much every syndicator got into a situation where they had to live on fees because the deals were so skinny that there wasn't. Can
you break the stack down for me? I've always wanted to ask you this since you brought it up. Where does a syndicator make money? The average, do they get paid to find the deal? Or go ahead.
Yeah. So the basic, I'll sort of run you through the basic fees, and then I'll tell you sort of the other fees that some people charge. But,
okay, thank you.
The basic fees are an acquisition fee, which you get paid at closing, which
is that 1 or 2%, or what is it?
Yeah, it can. I mean, at the high end, I've seen 4%.
Oh, wow.
But usually it's 1 to 2% of the deal.
Okay.
And that, compensates the, usually the sponsor is taking a lot of risk up front. They're putting up their own money as earnest money to get the deal. They're doing a lot, they're putting up all the due diligence costs. So if the deal doesn't close, they have a lot of risk, right? Okay. And plus there's a lot of work involved. So they've arranged everything, financing, they've raised all the money, they close the deal.
That makes sense. That makes sense to me. You get paid 1 or 2% to find a great deal. Okay, that makes sense.
So there's the acquisition fee. Then there's what's called an asset management fee, which is compensation for running the deal over the life of the deal. So that's usually, again, that's usually based on the money raised. So 1 to 2% of the money raised from LPs as opposed to the deal size. Okay. And then, or sometimes it's 1% of the rents, the top line revenue, kind of like the way property managers pay.
Okay, that makes sense.
So there's that. And then there's usually some kind of preferred return to the investors. And so a preferred return is not a guaranteed return. A preferred return is basically a promise that, I, Mr. Sponsor, will not participate in the profits of the deal until you make this much money.
It's like a hurdle rate. We've got to get you.
Yeah. Okay. So typically that's 7 or 8%.
Okay.
Right. So after you clear the 7 or 8% hurdle, then there's usually a split above that.
Okay.
Ranging anywhere from 30-70 to 50-50.
Got
right.
It. Okay.
And then the last major one is when you sell the deal, you get what's called the carried interest. And that is essentially you pay the investors back their money. If there's any preferred returns that haven't been paid yet, you pay those. Okay. And then obviously pay off the mortgage, whatever expenses or deal expenses, everything, whatever profit there is, then the sponsor participates in that. That's usually, again, 30%, 20 to 30% of the profit they get.
This is exactly why a lot of these big operations are going to go bust, because again, they've built operations where they need the deal fees to make payroll. And then at the end, if they can't make the profit, they're doing all this stuff for zero.
Well, so here's what happened. When I started out, that piece, usually so that you get the deal fee up front, right? Nice payday when you do a deal, right? And then, and maybe that's enough for you to live on for a while, right? Especially if you have a skinny operation, but what people really needed to have like ongoing income from these was not that asset management fee, because that asset management fee is usually not that much money and it gets eaten up pretty quickly.
Yeah.
It was really that split above the preferred return, right? The profit split. But
so that could be a yearly thing then?
Well, that would be paid quarterly.
Oh,
right?
quarterly.
But,
okay.
But back in the day when you were buying deals at like, that were easily producing an 8% return or higher, either right away or within a year or two, you could be into the money, because you're beating your hurdle and then you're starting to make some profit on top. And then, then if you've got like, 10 deals, you're actually making a living based on your share of the profits, right? So, but what's happened was when cap rates got so compressed, basically deals stopped even meeting the preferred return hurdle on an ongoing basis. So it was all being paid on accrual at the end.
Right.
So that led to a couple things. One, it meant that the sponsors really were dependent on more fees, more acquisition fees. It also meant they sort of became dependent on selling the deal fast.
Yeah, I was just thinking that they're incented to sell early.
Yeah, exactly, because they're kind of accruing. They're what we call behind the pref, right?
Yep.
It used to be that like being behind the pref was like this horrible, awful thing. You never wanted to be behind the pref. Now being behind the pref is like normal, right? Because the deals are only paying in the early years of a value add deal, you're only paying 2-3%, right? So you're accumulating this preferred return hurdle that every year it's piling up higher and higher and higher. And you can't get out from under it until you sell the deal and pay the accrued preferred return, because cap rates got so low. So that basically wound up kind of meaning that, a lot of people were required to churn deals, right? So
yeah, of course. I mean, that's and then you talked about there might be some things that are non-standard because again, people were
so then there's so then on some people with really, really massive audiences who are able to, basically like raise money in, I mean, I've heard like, honestly, people raising millions of dollars in 15 minutes, right? So people who got to that level of an audience could then start tacking on all kinds of other fees to the deal. Like for instance, construction management fee, or although that's fairly standard if you're doing a value add, but still it's not something that I had charged. But construction management fee or a disposition fee, meaning like you were getting paid
to buy and paid to sell.
Right, plus the profits that you're getting.
Yeah, plus the that's nice living.
And then also refinance fee, like if you refinance, we're charging a refinance fee. And then some people were charging. Now, like in lots of deals, you have, the sponsor doesn't have, the net worth of like $30 million to get the debt, so they have to bring in somebody.
A balance sheet partner.
Balance sheet partner, and they get paid a fee, which is fine. I mean, they compensate for that. But what I started seeing too is a lot of sponsors who did have the net worth started charging a
balance sheet fee
themselves, right?
Wow. Damn.
And it's kind of like my attitude is always like, well, wait a second, but I'm signing on as a sponsor, signing on the debt no matter what, right? That's part of
the deal, buddy.
That's the way I viewed it, as like, well, that's why I get paid all the stuff I get paid. Like I don't get paid separately again for doing what's my job. But a lot of people were charging that fee as well. So that, there were people literally making millions and millions on fees up front that they got paid no matter if the deal performed or not. Right now,
clearly.
A lot of people got lucky because the market was so hot that they could sell and make money and everybody was happy. Right. But those days are now,
back to greed and fear. That's what happens into the greed cycle right at the top.
Yeah, I'm not going to say that those days are over, but I mean, it's going to be harder.
They're coming to a close if they're not over. The door is closing.
There are going to be a lot of people who are not going to be able to rescue themselves by selling at a price they didn't believe they could get when they started out. And that happened to a lot of people. It happened to me. It happened to a lot of people. Like, we're literally like I had one really bad deal in particular that just like everything went wrong with this deal. Like it just was like a never ending story of like, you know,
the parade of terribles.
Oh my God. It was like at the point where like, if I saw my manager's like name pop up on caller ID, I was like, oh,
not again.
You know? And so, but even that deal, even though I sold quote unquote early, like we made a lot of money for our investors by selling that property.
Yeah, you got the wind at your back.
Yeah, and so, but those days are gone. Like can't.
They're gone.
And if you bought at the top, right, now there's no more up, like just to bail you out. You're going to have to wait a long time. I think a lot of people, for a lot of people, the best case scenario now is going to be just being able to refi and just survive and get into the next upswing. And they're going to have to hold these deals a lot longer than they expected, right? And some of them will come out okay in the end, but they've got to get over that hurdle of refinancing, right? And that's going to be the issue. And I think the stronger operators will be able to do it, right? But some of the weaker players are they're going to find it's really hard to refinance those deals.
Agreed.
And that's, you know, where the opportunity for other people is. Right?
Yeah.
So,
well, do me a favor, Jonathan. If somebody is an accredited investor and they want to see what a conservative operator does, I think they've got to get on your list just to see how you look at deals. How could they do that?
Well, there are multiple ways you can get on my list. You can go Google Two Bridges Asset Management LLC, and you can fill out the investor form on my website, and I'll add you to the list. And if you want to talk to me, which would be great, like I'm happy.
That's coming.
So
build a relationship, folks. It's about the operator.
Yeah, that's one way. The other way, I'm home today, so I don't have my handout to show you. But if you go to apartmentinvestorsclub.com, I've got a great free download there on, you know, the checklist of every single step involved in doing a syndication. That's for free if you want to, you know, upload it, and that'll also put you on my list. So either of those are good.
Awesome. Thanks, Jonathan. Have a wonderful day.
Thanks, you too.